Thank you. Mr. Elliott, you made a comment recently that you saw Victoria as one of the toughest places to do business. Can you expand on your observations, please?
So I was on the radio. I was responding really, it was around the payroll tax changes, and I had made the comment that, I have a view that that's a very unhelpful tax. You're taxing people's jobs and you're taxing employers for providing employment. It seemed like a strange thing to tax to me. I understand states have limited options, but nonetheless, I was making the observation that jobs go where they're welcome, and, it's a competitive world, and we operate nationally. We have businesses all over the country, operate internationally. And so interventions like that are not immaterial in our decisioning of where the next person we hire should be located. And so that was the comments I was making, and I got the question, did I think Victoria, therefore, was a tougher place to do business than others? And, in aggregate, we love Victoria, don't get me wrong. We're based here, we've been there a long time, we've been there 187 years, we're not going anywhere. It's our home, it's our head office, it's the state where we have the largest presence. We're not going anywhere. But, it's getting tougher to do business in terms of some of the government policies and things that we have to deal with.
Thank you, Chair, and thank you again to the panel. I only have one question, and it follows on from the Chair's line of questioning. You said, Mr. Elliott, that half of your customers have sought to engage with you to renegotiate their rates. That necessarily means that half have not. Many often report to us as members of Parliament, they get offered a better deal within a bank, including yours, when they seek to move, and it's often referred to as a loyalty tax. And if we can use an example in another area of the market, if a person goes to McDonald's and asks for, say, a drink, a cheeseburger and fries as separate items, the company's policy, as far as I've experienced it, is to offer a discounted deal, even if you haven't requested it. And that is in a highly competitive, price-sensitive market. So people are busy and time-poor. Leaving aside brokers that you referred to, do you, as a bank, proactively notify customers of better deals? And why shouldn't you?
Okay, we're not in the business of selling burgers, okay? So remember, a home loan, and I understand you appreciate this, is a 25-year commitment from somebody, right? And when every single customer is different. Every single customer's financial circumstances are unique. How much they earn, what their job is, where they live, what their house is worth, what their monthly income, their family circumstances, how many children they have or not, etc., etc. We have to individually assess every single customer. Our job, we want to grow home loans. We want more customers to choose us. So on the day, we put our best foot forward. Yeah? And literally every home loan is more or less individually priced. Sure, we have what we call a blackboard rate, the rate out on the window that we have. But in the end of the day, the vast bulk of customers get an individualised rate that meets the circumstances of their financial position, the way we think about them, and obviously competition. And so everybody's got a special rate, if you will, a discount, to use your term, on the day. And that's what we do to win their business. Look, the reality is, as I say, we enter into a 25-year or 30-year agreement with that customer in good faith. We put our best foot forward on that particular day. Sure, things change, rates change, circumstances change. And most customers, as I say, do re-engage pretty regularly, but not everybody wants to or is incented to do so. And so I don't know that there's... I understand you say let's dismiss the broker piece, but brokers are three-quarters of the market. Three-quarters of the market are actually coming through brokers. Brokers are better informed about competition, better informed about prices, better informed about terms and conditions than we are. If you go to a broker today, they know what Westpac, CBA, Macquarie, everybody's offering. I don't know. I only find out really in hindsight. So the system works. People are informed. Those brokers are reaching out to customers to tell them if they can get a better deal.
And just to be very clear, we're not suggesting, I don't think the Chair was either, that you're offering the full suite of deals within the market. We're talking about the best deal within your bank. Can I give a narrow example? If someone is coming off a fixed term rate, do you engage with that person before that occurs?
So what happens when you get a fixed rate? So when you come into ANZ and you want a home loan, let's imagine it's a 25-year home loan. We assess your ability to pay that home loan at the variable rate plus 3% for the 25 years. That's what we assess, yeah? Now, we make a whole bunch of assumptions about your income, and you have to tell us how much it costs to run your family and all those other things. And we say, can we assess that this person can afford responsibly to maintain this home loan over the period of time at the variable rate, whatever that might be? Yeah, so our ANZ stated variable rate, etc. If you qualify, we say to that person, by the way, you've met our agreement. You have the option to lock into a fixed rate for a period of time, 1 year, 2 years, 3 years, 10 years, whatever that might be. Most people choose 1 or 2 years. At the end of that period, you will revert automatically back to the floating rate. So that's sort of the deal that happens, yeah? As we get closer to that switching point, absolutely we tell people, hey, by the way, we write to them, your home loan switching, it's going from 1.94%, next Tuesday, well, we give you months of notice, and it's going to revert to the variable rate. This is the variable rate. Pretty clear that at that point, a lot of customers therefore take that as a signal to shop around, talk to the bank, can I do better, perhaps refinance, perhaps look elsewhere. For absolutely alive and well, and that's precisely what happens today.
And do you have internal incentives for any of your staff to not offer the best rate to customers within the bank?
No. So every circumstance, as I said, best rate is we're required to treat every customer as an individual and think about the responsible lending for them. So it's not quite as simple as that. But no, we absolutely don't have an incentive to say no. We have to offer the best rates that we can. What we do, we have rates. We have a rate sheet, for want of a better term. Obviously, it's digital, but a rate sheet for depending on loan to value ratios and all sorts of variables that our pricing team can apply. But there'll always be, special circumstances where people will ask for a better or different things, and we have a process of escalation where people can make those pricing decisions. But those pricing decisions are always to give a customer a better rate, not to give them a worse rate.
And when the proposition for the ACCC recommendation on a requirement to engage was put to you, you resisted that by the chair. Given your statistic of 3/4 of customers having brokers, would you agree that those that don't are being engaged in a form of loyalty tax?
Not necessarily. I mean, it's a term that I don't think our customers feel that way. As I said, I have confidence our customers are not foolish. They understand their loans. And again, not all loans are the same, and not all people's financial circumstances are the same. And so people act according to their own needs. And as I said, there's no evidence to suggest that people are unaware or that it's news to them that they may be able to get a better deal and that, they can ring the bank or go to a broker or approach another bank. And as I said, people do.
Thank you, Chair, and thank you to the panel. I'd like to focus first on housing. Mr McEwen, you singled housing out and you focused in on supply. Your ANZ colleague this morning also mentioned housing, but he singled out population. Would you agree that both matter, and that if we are to return to post-COVID migration levels or more, the requirement to release more land is increased even further?
Yes, and that was in my opening comments, Mr Wilhan, that it's very clear that we need to get more land available for building of houses very quickly. We have got an increase in population coming in through migration, which will put pressure on a pretty pressured system at the moment. And I think we need to think of it in 2 or 3 different ways. First off, making sure that we've got affordable housing in the right areas for those that need it, that can afford but need some help. Social housing, as I've said, we bank parties like the Salvation Army, and I've been spending quite a bit of time with them in many centres, and it is very clear we need a lot more social housing in the right areas and need to be working on that. And then there's just general housing and apartments that we need for the population growth that's going to continue. And that needs land.
Thank you. I'm interested in the data that you have from your customers on the share of first home buyers versus investors. Who of that category have you found is more sensitive to increases in interest rates from the last 12 months?
Well, first of all, we'll just get you the numbers on first home buyers, Mr. Walhan. We've been a big party in providing funding for first home buyers through one of the government schemes. And I think we saw it go up to, Rachel Banks, of about 17% of our new business flows. We're now back down to that 10 to 12%, which is a normal flow you'd expect in any one particular year going into first home buyers. Rachel, I'll get you to cover off on that topic. And are we seeing, and then maybe Sean, any stress that we're seeing in the first home buyer versus any others? And is that abnormal? Because it may be normal, but I'll get Sean to cover off on that one for you. So first off, just trends in the first home buyer.
Yeah, so in first home buyers, I'm talking about our first half of the financial year, Mr. Wallahan, so 6 months to March this year, represented 11.2% of our lending flow, and that's very similar to where it was in the first half of 2019. The 10-year average is lower than that, just under 9% at 8.7%. So all of the months actually since September 2017, except for a couple of months in 2022, have been above that 10-year average. So certainly first home buyers into the market, but also, as Ross mentioned, we've been very active participants in the government schemes to support first home buyers. So we've done that over the last couple of years. Sean, you might want to talk to.
Thank you. So we're not seeing a material difference in the performance of first home buyers versus the rest of the portfolio. What I would say, however, is that first home buyers, by their very nature, are probably going to be more highly levered, and probably their income levels may be on average lower than the others. So we certainly watch that sector pretty closely, but we're not seeing any material deviation of the performance at this stage. But one we continue to monitor pretty closely, as we do across the entire customer base.
Thank you. I'm interested in your views on the resilience of your customers, and again to refer to your colleague at ANZ, Mr. McEwen, he sort of gave evidence that his customers are more resilient than maybe some of the anecdotal feedback that we're getting as members out in our communities. What is your sense of the breakdown of your customers for those that are doing it tougher in terms of whether they're in different states, different ages, or different other categories? Are there sections of your customer base that are struggling more than others as interest rates and cost of living goes up?
No, thank you, Mr. Wallahan. First off, just looking at what's happening in the Australian mortgage book, we have been pleasantly surprised at the resilience that has shown to date. And I'm happy to give you the trends on that as well, because we are starting to see an uptick in what we call our 30, 60, 90 day, where customers have not been able to make the first payment or make a payment. They miss one in 30 days. Do they then miss a payment in the second month, which is 60 days? And do they miss a payment in the third, which is the 90 days? But the levels that we're seeing are still below, the 10-year average and the levels we saw in what we still consider to be a normal year of 2019. So still very resilient, but we're also very aware that about 45% of those that were on a fixed rate that was down in the 2% and now rolling through into a 5.5 or 6. About 45% to date have rolled through, and we've still got 45% to go. Now that 55% to go. That 55% we don't think is any different to the 45. So it's not as though we've got different cohorts in those groups. And assuming that there aren't, we're still been surprised how low the default rates have been, and we are watching that like a hawk. But there is starting to see an uptick, and I think that's coming through from interest rate rises. It's coming through from all of the other prices that are going up on customers, and they're having to make real choices. I'll get Sean to take you through other numbers that he's got and maybe put that in perspective. Sean, have you got any other, because one of the questions is around regional or areas that we're concerned of. Do you have anything of that nature?
So what we look at across our total portfolios, we look at areas of potential vulnerability. And so we look at the profile of our customers, and we look at the proportion of our customers that might be relying on a single income, for instance, in terms of the household earnings. We look at the profile of their expenses and the amount of serviceability buffer that they had at the time of the original loan. And so we continue to look at those parts of the portfolio. And as Ross said earlier before, that we are seeing some bifurcation in parts of the portfolio. The long run averages are certainly higher than what we're experiencing at the moment. As Ross said, we're seeing an increase in the 30-day past due in some parts of our portfolio, but a lot of it's curing itself as we roll into 90 days past due, and most of our public disclosures, as you'd appreciate, focus on the 90-day past due ratio. And so we're seeing that perform probably better than what we saw pre-COVID, and certainly better than the long-run average. In terms of regional differences, we will see certain postcodes across the economy that, for whatever reason, have had a more volatile economic situation or dependency in those portfolios. So we've been monitoring those for many, many years, and we track the performance of those. But what I'd say is that it really gets down to borrower-specific issues as opposed to necessarily a state-based issue.
Thank you, Mr. Dooley. I put a question to Mr. Elliott early this morning that there was a report from the RBA in January that noted at a 3.6% cash rate, 15% of borrowers were in negative spare cash flow, and we're obviously now at 4.1. How do you reconcile that observation with your evidence on resilience today?
Do you want to say that one?
Yeah, I'll take that for the start. So a number of things that we've seen over the last few years. One, customers have been paying down their mortgages. So the number of months ahead for our customer base is about 41 months ahead on average. So our customers have taken the opportunity over the last few years of lower interest rates to continue to pay that down. We've seen the household balance sheets continue to strengthen probably over the last few years as well. House prices have increased, savings rates have increased. We also see customers taking action to manage their own expenditures as well, to ensure that they can deal with all of the outgoings that they're facing. So we're seeing a pretty resilient customer base, actually, and it's held up probably better than what we expected this time last year. And certainly, there is some prospect of further interest rate increases, and we continue to monitor and engage with our customers very closely, as Rachel said earlier and Ross said. We talk to many customers, we check in with them, we see how they're going, and we've certainly got a very extensive NAB Assist program to help customers who might be starting to feel some stress.
Thank you. Mr. McEwen, your headquarters are in Melbourne, like ANZ. Do you have an opinion on the latest payroll changes in the Victorian state budget?
Well, we do enjoy being in Victoria with our head office, but we do have lots of other staff in other states. But it is probably now one of the most expensive states to operate in as a large business. With the latest tax rise, that move alone cost us well in excess of 30 million. Add that to the top of the one prior, was pretty much a similar number. So, but we still enjoy the most livable city in the world, I understand. Hopefully it makes up for it.
Mr. McEwen, you probably won't expect much sympathy for people to hear a bank lose money, but can you perhaps articulate what some of the consequences for your employment decisions in Victoria might be that flow from that?
Yeah, well, it's that money, goes to a good cause. We hope for mental health issues in the first one, and second one's to pay down the state government's debt. So those are good causes to get underway. But I think we just have to be, we do make decisions about where we house our staff over time, and those things become considerations.
Thank you. And just final question is about the topic of a loyalty tax. I put questions again to Mr. Elliott about customers that may be too busy or time poor to shop around for a better deal, or they don't have a broker. Does NAB have a policy of notifying your existing customers of potentially better deals?
Look, I'll pass that one to Rachel. I'm not too sure. I've been in the business a while in Australia and overseas, and I'm not too sure I've seen as competitive a market as we're seeing at the moment for customers making proactive contact with us, and 70% through a broker market. But Rachel, maybe if you want to make comments on how that market's operating, particularly in mortgages.
Yeah. The thing I'd add, of course, I'd agree, I've never seen a more competitive home lending market. I've also never seen, and it's not surprising, customers so engaged with their finances, and particularly with their home loans. So there's clearly at least two things going on for customers. So the first would be customers who took up a shorter term fixed rate offer in the last couple of years. As they're rolling off, clearly they're engaging with their bank on what that new price is. And secondly, with 12 interest rate rises impacting customers, any customer that's on a variable rate product will have been contacted by their bank regarding interest rate changes. So we've had pricing conversations with more than a third of our customers over the last 6 months, and I'd expect that to continue. So customers aren't really needing to be prompted to be active in the market.
Thank you all, and thank you, Chair.
Thank you.
Thanks, Mr. Wolahan. I'll pass